Hi everyone, I'm Isa Martinez, trader and market analyst at xChief. This week we're diving into the key markets movements and what's driving the action. From tech pullbacks to year-end positioning, we'll break it all down so you can stay ahead of the game. Whether you're new to trading or a seasoned investor, this analysis is tailored for you. Let's get started. So first of all, we're looking into Thursday, January 2nd at 7:30 a.m. with the US dollar. We will have the unemployment claims, and this report shows how many people file for unemployment benefits for the first time during the past week. It's an important indicator of the health of the job market. A lower number generally means the economy is doing well, while a higher number could signal potential trouble. Now let's head to Friday, January 3rd at 9 a.m. for the US dollar. We will see the ESM manufacturing PMI. This index measures the activity level of purchasing managers in the manufacturing sector. A reading above 50 indicates expansion, while below 50 shows contraction. It's a key gauge of manufacturing health and can influence market sentiment. And now let's go to the fundamentals. And Wall Street faced a decline on Friday as tech and growth stocks pulled back after leading recent gains. Dow Jones dropped 26%, the SP 500 1.68%, and the Nasdaq slid 2.25%. Professionals explain that the market is under pressure due to year-end profit-taking, tax loss selling, and portfolio rebalance, particularly by large funds. Thin trading during the holiday season amplified the selling pressure, while uncertainties around inflation, interest rates, and potential policy changes in 2025 added to investor caution. Experts also noted that the tech sector, after a strong rally this year, is undergoing a health correction. Liquidity remains a key driver for the market, and with fewer active participants, the recent rally has lost momentum. Key technical levels, such as the 50-day moving average, are being tested, raising concerns for further downside if those levels aren't maintained. Additionally, tax planning and repositioning ahead of 2025 are dominating market behavior, with investors locking in profits for 2024 strong gains, while the Santa Claus rally is historically expected this time of the year. Professionals caution that it's not guaranteed, especially with a more challenging macroeconomic backdrop. Bitcoin stayed relatively stable on Friday, edging up by 0.6% to $96,521 in soft year-end trading. Investors remain cautious about cryptocurrencies after the Federal Reserve adopted a hawkish stance last week, signaling only 2 rate cuts for the upcoming year instead of the previously expected 4. On Thursday, Bitcoin dipped toward $95,000 following an anomaly in trading's view Bitcoin's dominance chart, which falsely displayed Bitcoin market share dropping by 0%. This error led to sudden market reactions, with roughly 33 million in long positions liquidated within hours. Although the issue was quickly corrected, the event added volatility to an already cautious market environment. Currently, Bitcoin is on track for its second consecutive weekly loss, after hitting a record high of $108,244. And this was because of the optimism around Donald Trump's election victory. The Fed's rate outlook has dampened enthusiasm for speculative assets, driving a pullback for Bitcoin's price. Altcoins saw limited gains on Friday, but are set to close the week with losses. Ethereum rose 1% to $3,378, but remains down nearly 5% for the week. XRP gained 8%, while Solana climbed 3% and Polygon gained 2%. Cardano stood out with a 3% increase, reaching 89 cents. Among meme coins, Dogecoin edged up by 6%. With the Fed's hawkish pivot and macroeconomic pressures reshaping market sentiment, cryptocurrencies face challenges as liquidity concerns weigh on speculative trading.
Let's begin our analysis of the charts, starting with the strength of the dollar. One of the key movements we've observed is that we've stayed within a range throughout the entire week, and it's likely will remain in this range until the end of the year and probably into the first few days of next year. Why is this? It's because we're in the holiday season, a time when trading volume is typically low and professionals aren't usually putting much force or volume into the market. It's highly probable that we'll maintain the range we're currently seeing, a range that could persist over the coming days, and it's also unlikely that we'll witness strong movements that could break one of the two zones I'm watching. I'll highlight them for you to keep in mind. The first zone is at 208.541, which would be our resistance level to break if you expect the price to keep rising, and the support that should break if you remain bearish on the dollar's strength. I'd say you should keep in mind the 107.570 level as the most important area to watch. Now, if you're still trading based on dollar strength, consider the 108.986 level as an interesting area to watch. If you're looking to make a bearish trade, I'd suggest keeping an eye on 106.698, 106.354, 106.40, and 105.798 as potential downside targets to consider. Let's move on to the next chart, the S&P 500, which we always pay attention to and which is always very significant. As I've been mentioning over the past few weeks, we're still seeing bullish momentum with the S&P 500. We see that despite the recent drops, as we had explained earlier in the channel, this area is extremely important. We should look for upward moves, not try to chase falls, because the S&P 500 had strong bullish momentum. So we see that in last week's movement, there was a rise from 5,842 to 6,049, which was actually the last area we reached. However, we haven't seen a strong enough upward movement, so we must consider that the price could still make an upward move towards 6,099, the latest all-time high, to try to close this year above that level. It'd be ideal for the S&P 500. If not, we might achieve it in the coming days after the new year begins. There may still be bullish targets, but be very careful when trading. We've been discussing downward movements, especially about the S&P 500 having strong falls, but that's not what's going to happen. Again, the key idea with the S&P 500 is we need to look for corrections, not to trade dips, but to use these corrections to join when the new upward trend starts. That should be our S&P 500 strategy. If you're still bearish, I'd suggest targets at 5,824, 5,696, and 5,674. These areas might offer liquidity points for the S&P 500 that could serve as support, allowing you to close your positions if you're bearish. If bullish, I'd keep my targets at 6,099. And if you want to consider, we could still keep in mind the targets of 6,105, the next key point where the S&P 500 might face resistance, and 6,198, which is also another area I left with you a while ago. Let's move on to the next euro-dollar chart. We've been talking a lot about the euro lately, over the past few days and weeks, in fact. I've mentioned that the euro-dollar still lacks the strength to attack upwards again. It's highly likely that the euro-dollar chart will continue to move downwards. In fact, over the last 2 weeks, we've seen this downward movement, which has reached the 1.0343 area. This was one of the key zones for the euro-dollar. We've returned to one of our targets, which was 1.04251. From here, we should look for new movements that will likely remain upward, taking into account these points. Look, the low that's been generated and also the last low could start to establish a bullish pattern. Therefore, we could remain bullish on the euro-dollar. However, keep in mind that we're in holiday season, and it's likely that the movement we see won't be as significant. The market might be less active during this time. Let's see if we don't get the expected strong movement, but rather range-bound moves, at most reaching nearby liquidity zones. A key liquidity zone I'd watch above is 1.04476, and a zone I'd watch below is 1.03837. These are areas the price could reach without any issues. In the less likely case we see a strong trending move, you could watch the 1.05345 level as a target for the price to continue rising, giving you a clear objective to take profits on the EUR/USD. I'd remain cautious with EUR/USD this week. Finally, we close with Bitcoin, trading at 95,032 at the time of recording this video. The most interesting thing we've seen over the past few hours, or rather past few days, on the 4-hour chart are these. Here you can see the lows the price has left us. You can see a low here, another low here, another low at this point, and the last low generated here. These are areas where we see the price has created increasing lows, which suggests we could have a developing bullish structure. The targets you should consider in the coming hours, I'd set a target at 97,340 here, and we can set another target at 99,887, which is almost $100,000 for Bitcoin. I maintain the same view as with other assets. While I'd still expect a bullish structure for Bitcoin, we shouldn't expect very strong movements. Don't expect big moves by year end or even in early January 2025. We won't see major price moves or new highs soon because the most likely scenario is that we'll see limited movement, a range-bound movement. However, I'll give you two easily achievable targets, 97,340, which I'd say is very easily reachable, and 99,887 or $100,000 to make it simpler. These are points where the price could reach by year end if you remain bearish on Bitcoin. I really like the zones that have been defined, and I'll highlight them here for you. The zones defined by the latest liquidity points are very close: 93,234, 92,360, and 92,055 as areas to consider for potential price drop.
Thank you for tuning to this week's market analysis. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and share it with your fellow traders. And if you're ready to take your trading to the next level, sign up with xChief today and start your journey. See you in the next video.